commodities. I think we should talk about this because we are at a structural change in the demand of certain commodities driven by the EV transition. And it's always an interesting situation. Before I go into details, uh, commodities are generally not an interesting investment topic. However, whenever there are special changes, structural changes, or what's called secular changes sometimes in the investment world, which just means that something is different. Some big change in the demand supply situation of an industry is changing. Those are the times when commodities actually could be interesting investments. And I think we are in a time like this. What's important to understand here is two things. First, the commodities industry, by definition, is the antithesis of the principal stack that we believe in at Orange Capital Partners, or believe is the wrong word, that we build our investment process on. The reason that is the case is because there's nothing unique, there's nothing creative, there's nothing special, there's no David Deutschian creativity or innovation or anything like that happening in the commodities industry. So for that matter, we're absolutely not interested in the commodities industry as an industry. This is not a long-term holding for us. However, in the certain periods of time, the commodities industry can be an interesting investment. And the reason for that is because some changes happen in other industries that demand different types of commodities or different types of mining or both. And that is the key what's going on right now. So whenever there is an interesting time in the commodity space, the real question to ask is, okay, why is that happening? Which industry is actually changing? And usually there's a lot more money to be made there because that's where the innovation is. So in this example, for example, we have Tesla, which is changing the car industry, which drives demand for nickel and lithium. So in other words, the interesting part here is Tesla, not the lithium or nickel industries. However, as investors, we should be looking at those industries for two reasons. One, there could be a short-term opportunity to make money. And second, you always learn a lot from the mining companies about their customers and about the industries downstream. This is not in the wrong podcast. It's March 30th, 2022. This is Crimdelco. For the day, the fund is down 1.3%. The market is down 1.2%. For the year, we're down 3.5%. The market is down 3.6%. We are outperforming by 10 basis points. Let's just jump right into it. Maybe before I jump, let's talk a little bit about the market. We had a big reversal. We were down almost 35% 3 weeks ago, 2.5 weeks ago. Now we're almost flat. This is, of course, great. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. We've said many times on this podcast before that we need to embrace volatility. It's part of the investment process here, and this is a very good example. The last couple of weeks show how serious that is. So what that means is you have to understand your leverage, you have to understand your stomach for risk, and you have to be able to sustain these types of volatilities because they happen for several reasons. And what's going on currently is we have an overlap of three different things. You have, number one, a post-COVID recession, which is looming. Number two, we have inflation because of supply chain disruption. And number three, we have the war in the Ukraine, which drives inflation again. So those are three things that are serious. Of course, they're problematic. We have to deal with them. But what's fundamental for us in our portfolio is that actually, and we've spoken about this in one of the last episodes, everything that's happening right now in the zeitgeist, the change in the zeitgeist, the big fundamental changes, secular changes are actually all driving towards what we have in the portfolio, which is primarily Tesla. We have a de-Russianization of the economy. We have the change of the NIMBY problem from NIMBY towards, okay, fine, it's okay to build in my backyard as long as it's clean and follow certain principles. So all of these things are being taken care of by Tesla. Tesla is at the forefront of the zeitgeist here, and of course that is phenomenal. I've said this also before. The fundamental situation for Tesla has never been better from the demand perspective, from a perception perspective, and also from an execution perspective. Of course, we don't have full insight into what's going on with Tesla, but it looks like the company is able to execute against its growth plans and even execute above that, given how much demand there is right now. So having said that, let's transition now into the mining sector, and I think it's a good transition because the reason mining is interesting is primarily because of Tesla. Tesla is driving demand for electric cars. Electric cars require a lot more nickel and lithium. Let's leave it at those two. There's a lot more other stuff like cobalt and things like that, but let's focus on those two. The reason we need different and higher grade lithium and nickel is because the performance of the batteries that Tesla is bringing to market requires that type of grade. And this is also already the first point. There's been reports recently about why Tesla is so ahead of the curve. And Tesla is ahead of the curve when it comes to sourcing materials for two reasons. One is the company has been planning for growth for years now, so they have a plan in place, they have contracts and all that stuff in place. But second, and more importantly, they've not just been planning for growth, but they've been planning for growth in the right grades of materials, because they are actually defining what the grades of the materials are going to be in the future. Tesla is the market. And I've mentioned Michael Milken recently. He was one of my sort of inspirations when I started on Wall Street. And I know there's going to be a lot of pushback now. And how can you be inspired by a guy who went to prison? Yes, he went to prison. He did a lot of things that are not okay. But the one thing that he did, which I think is a good lesson for every person that is involved in any kind of market, is that he made money by becoming the market. So when you are the market, when you're not just playing the game well, you are the game, then of course making money is a lot more straightforward. And this is what Michael Milken inspired me to do. Of course, in a legal way, I don't want to use some of his methods, but I think if you can be the market, then you create a lot of wealth. And this is also very Peter Thielian in the sense that he says that the best way to create wealth is by creating monopolies. This is just another way to say that you become the market. Now, Tesla is becoming the market. Luxury, electric, autonomous vehicles are the transportation medium of the future, and Tesla is defining that market, and therefore Tesla has the luxury also to be ahead of the curve. So this is not a sort of a nice feature of the current situation. The fact that Tesla is ahead of the curve is implicit in the current situation. It wouldn't be, if Tesla wasn't ahead of the curve, then Tesla wouldn't be defining the market, then Tesla wouldn't be driving the market, then nobody would be talking about EVs, because all the legacy automakers and even the followers like the Lucids and the Rivians, and they wouldn't be where they are today if it wasn't for Tesla. So Tesla is the horse that is driving this whole carriage forward. And because of that, they have the luxury also to define what kind of lithium and what kind of nickel they want for their batteries. And that's why they're able to source way ahead of everybody else. So basically, in other words, everybody else has to go and scramble, figure out what Tesla is doing, and then try this to get the supplies necessary to catch up with Tesla. That's the first problem that everybody else has. The second problem that everybody else has is to do it at speed. The third is to actually, even when they source, if they can source all that stuff, actually be able to make the kind of batteries that Tesla is making, and then implement them at scale, produce at profitable like Tesla. All that stuff is almost impossible if you think about the legacy automakers and even these new guys like Rivian. They just are way too complicated, way too complex. It's way too slow. Rivian, in my view, is just a bunch of academics who have been able to raise money and pay themselves nice salaries, a lot of it in stock, and eventually will not succeed because they just don't have the DNA to compete with somebody like Tesla. So now, what does that all have to do with mining? I think for us at Orange Capital Partners, we have been involved in mining companies in the past. It's an interesting industry to learn. However, it's not an interesting industry to invest because there is usually, over the long run, always it becomes a cost of capital business because of competition, because of margin erosion. A cost of capital business can still be a good business, meaning if you can do, let's say, 300 basis points above cost of capital, and if your cost of capital is 10%, you can still do double-digit returns over the long run, which is certainly a good return. It could be lower, it could be higher. That depends on the interest rate environment and things like that. So over the long run, you can still do well by investing in mining companies. However, it is not the kind of wealth creation that we're looking for. But we do like to invest in or at least work on the mining industry for two reasons. Like I mentioned, the prelude. One is that you have short-term opportunities to make money. There is sometimes an opportunity. What I mean by that is that when there's a secular change, you usually have a shift towards different grades of mining. So there is innovation actually in the sector. Who is first? Who figures out first how to supply this new industry and tends to outperform the rest, tends to be usually also bought by the large companies. So there's money-making potential for investment companies like ours. I think the more important reason is, though, the second, which is you can learn a lot. When there was a financial crisis in 2008, me and my partner Zovina, we went to Chile and we actually spoke with Codelco, the largest copper company, and we learned a lot about China back then because copper is, of course, one of the biggest resources that China is buying from Chile. So they were able to give us just basic, honest, humble comments, uh, feedback about their main customers, which is China. And we learned a lot about China in those days, and that helped us a lot form our investment thesis for the future as far as Orange Capital Partners was concerned after the great financial crisis in 2008 and 2009. So there's always something to learn because the mining companies might be very stodgy, kind of old-fashioned type industries, but they do have customers and they do think a lot about the macroeconomics and the situation within the industries that are impacted by their products. So in this case, it is worth looking into mining companies that are in the nickel and lithium space because they will probably be able to tell us a lot about their customers, the car companies, the battery companies, and we might learn a lot about that. So this is one of the reasons why we will start working on the mining sector going forward. I think it's also important to understand what is going on in the mining industry. In a nutshell, what's happening in the mining industry is the following. And again, I'm focusing here on lithium and nickel. So let's talk about nickel. Nickel is a product that is mainly used for steel, for stainless steel, and stainless steel is being used in things like high-end construction, and a lot of it is also used in, let's say, household products. One of the largest nickel users, so not producers but users per capita, is Italy, and that's because Italy produces a lot of nickel-based cookware and things like that. So this is a good example. If you look per capita consumption of nickel, Italy stands out because Italy is a consumer of nickel for high-end cookingware and furniture and things like that. Now, what's good about nickel, of course, is it's sort of iron that doesn't rust, which is very good, and it's high-end, it's expensive, and this and that. Now, what's happening is that the EV space is requiring higher grades of nickel. In general, what nickel does is it's an add-on to the lithium-ion battery, which improves performance. And if you want to build high-end electric cars a la Tesla, you need high-grade nickel. And the demand for that high-grade nickel for a long time was very low because the main demand for nickel came from EV makers in China, which make low-end electric cars. Only after Tesla went from being a niche producer to a mass producer, which they are now, only now the nickel producers actually are taking this market seriously, and now the race is on, and Tesla is ahead because they've secured their supply already way ahead of everybody else. So this is what's happening in nickel. Actually, the very same thesis can be formulated for lithium. So again, higher grade for high performance batteries. The only player with high performance batteries is Tesla, or at least at scale player. And because Tesla is now at scale, everybody's taking them seriously, and the race is on. Same thing now. Having said that, of course, there's always the potential for substitution. So that's another reason why we're not very interested in actually investing in the nickel and lithium companies, because there is potential for substitution. So whenever you have the secular change in the mining industry like this, it's always very advisable to look at the downstream chain and understand, okay, which industry downstream is the most competitive, has the most margin and growth potential. And if you look at the, let's say, take nickel again, you have nickel producers, they sell to battery manufacturers sell to OEMs. Tesla is, of course, integrated, so nickel goes straight to Tesla. And the reason this is important is that, of course, if you have a company like Tesla, which is fully integrated, at this stage of the cycle, it is very highly likely that Tesla will reap the highest margin. There is potential at some point that the battery manufacturing process will be outsourced because it will be commoditized, but we are not at that point right now, and therefore we believe that Tesla still has a lot of innovation left. Of course, 4680 is another example of that, and that we therefore should be investing more all our capital in Tesla. And we've said that many times also, Tesla is our cost of capital. So when we look at a company, let's say in the nickel space or in the lithium space, we always should think, okay, where is the return higher, with Tesla or with this company? And in the short run, maybe there could be a higher return achievable by investing in the nickel companies, but then we have a timing problem, which of course is very difficult. There are situations where you can time investments. It's not impossible. It just requires a lot more intelligence, a lot more work, a lot more technology. We have that in place. We have those resources available to us, and we might choose to deploy them at some point and then invest in, let's say, a wildcat mining company in Minnesota or Nevada. It is not out of question, but again, it requires a special skill. So the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. So for anybody who's out there running a fund or anything like that, first and foremost, of course, this is not investment advice. Please do your own work. But what we want to convey here is not the question, should I invest in nickel or not? What we really want to convey here is the following. If you choose to invest in, let's say, commodity companies, first ask yourself, okay, what is the downstream secular change that is driving this demand for whatever it is, let's say in this case, nickel? Second, ask yourself, where is the highest return achievable? It could be downstream, it could be in the battery side of things, it could be in the OEM side of things, or it could be in the nickel side of things. It is certainly possible. If there's a company that sits on very, very interesting assets, there's a company in New Caledonia, a French listed company called Eramet, that is very interesting because they have a very unique asset. This is from the colonial times, but nevertheless, they have it and they own the rights and they have very good access and logistics. And a lot of times, let's say, in the commodity space, having access to port is crucial, and not being involved in political turmoil is crucial, and all these things matter. So if you can add all these things together, you could have a very unique asset, and that unique asset, of course, could become a takeover target or just generate very high returns on equity. So all these things are possible, but again, it requires special know-how, special technology, and also timing. The timing requires incredible finesse because you have to time it also in terms of the macro environment, the interest environment. A lot of things have to go right for you to make money in a timing type trading strategy versus when you have a long-term principal stack driven trading strategy like we have at Orange Capital Partners, where you invest in fundamental new concepts and engineering practices with large impact, then you have a better chance to weather the cycles and make money over the long run. So to summarize, interesting developments in the commodity space are by definition interesting because there is usually a secular change somewhere downstream. And when we look at types of industries like that, it's worth looking at the mining industries first because there could be an interesting investment in the mining space, but more importantly also there could be interesting developments downstream, and that is something that is very interesting for us. Thank you.